Hey everyone, Siddharth here coming to you with a brand new video. And today's topic is understanding the influence of interest rates on debt. So, I really wanted to speak about this specific topic because some news has come out regarding the US Federal Reserve, which is basically the central bank of the US, cutting interest rates. And I really thought it would be a good opportunity to speak about how interest rates actually have a long term effect on debt, but also indirectly how they have an effect on money itself. So, currently, if you look at global economic situations, there's a lot of different economies that are sort of operating in low level base interest rates. Now, interest rates essentially are, the cost of money itself. So, what tends to happen is when there are lower interest rates or there are environments where there's access to lower interest rates, what it essentially then means is that all your different banks in different regions or countries can actually start offering loans that are a lot cheaper because interest then becomes a cost of money. So what that then essentially means is that with interest rates being lowered each time, there's obviously an opportunity for banks to start issuing a lot more money, which is basically cheaper money to the general public. Now, what tends to happen is, especially in economies where economy is moving really slowly, there's not a lot of progress. Perhaps a country is going through what's called an economic recession, or there's a downturn in the economy. One of the ways that a central bank that controls a money supply in an economy is to try and get some money out there that will enable the general public to actually start consuming a little bit more and obviously kickstart the economy from that aspect. So one of the issues is that when you start providing money that is a lot cheaper, what tends to happen is people feel, okay, there's a lot of easier money for me to access, then maybe I can actually start borrowing a lot more because I'm actually going to be paying less in terms of the cost that I'm paying on my money or debt that I'm borrowing. Now, what doesn't seem to be reflected immediately, obviously, is that perhaps there are people that may already be in a sort of debt situation that is very difficult for them to obviously get access to money, which was previously more expensive because of a high interest rate environment. So the moment you have rates that start dropping, what it then basically means is people that are in a sort of big debt situation start borrowing a lot more because now they feel it's a lot cheaper to borrow money as well. There's obviously other aspects to consider, like your credit profile, which can also determine whether you will be able to access that money. But I just want to stick to the point of when people start having easy access to money, what essentially then happens is by them borrowing a lot more, they obviously start getting into what is commonly called a debt trap. So what then happens is because they've started getting used to the aspect of borrowing money at a lot cheaper because of the lower interest rates, they believe that as time goes on, they'll be able to sustain themselves and they'll be able to pay off those debts over time. But actually, what tends to happen is, banks obviously are starting to make money because they are obviously offering these loans which are a lot more affordable, which means there's a lot more loans out there in the public. There's easy money, but the other problem is with the easy money that's being available now, it has an impact in terms of the actual value of the money itself because there's an easy sort of supply circulation. Anything that is a lot more available in vast quantities or vast supply essentially drives down the value of that specific commodity or whatever it is that is related to some kind of value. So if you think about money which is becoming a lot more available, it essentially then means that the value of your actual money, what is also commonly called your fiat currency, starts dropping. Now, when that starts dropping, what it then essentially means is that people are actually starting to have lower incomes that are, perhaps not really retaining their actual value. So the other effect is that when there's a lot more money supply in the economy, eventually prices start going up because people start demanding a lot more goods because they have a lot more money that is available to them. So in essence, to conclude basically this topic, what it then essentially means is by being in environments where there's lower interest rates, it is actually quite a dangerous phenomenon, because then essentially then means that people are starting to get access to money which is a lot cheaper, which then actually means specifically in economies where there's not a lot of net savings, people then actually start getting into a debt trap. Now, why is this pretty critical? Because if you think about, your debt, you essentially are a person that doesn't actually have value, because then your net worth, which is basically the difference between your assets and your liabilities, actually starts becoming negative. So it's really critical, by understanding how lower interest rates, start affecting, the phenomenon of easy money or easy liquidity, how it can lead to a debt trap. And that is why it's crucial to ensure that you start creating assets, because in such environments where your interest rates are sort of being lowered to spur on economies that are very stagnant or they're not moving at all, even more critical then that you start building those assets. And there's various ways you can do that, as I've mentioned in my previous videos. So it's up to you as a person to start ensuring that you're doing your research and understanding what assets actually are helping you preserve your value, especially in times now where we are operating towards a low interest rate environment. And the other aspect I want to mention is that it's very easy to get to a point where you have basically what's called negative interest rates. So negative interest rates essentially means that banks get charged a penalty for actually keeping money like deposits in their account, because the central bank wants money out there in the economy so that people are actually using it. So I hope this topic was really insightful, and it helps you start thinking about how exactly the aspect of interest rates affect or influence debt, and that how in turn actually affects your specific assets and your wealth. And from that you can actually start thinking about what are the different things you need to consider about protecting your wealth and also the value of your income. So thank you for watching. Hope that was insightful. If you haven't yet subscribed to my channel, please do, as I keep releasing new videos each week. And I hope to see you as a new subscriber and on a new video in another week. Thank you. Take care. Bye.